Good morning, welcome. Thank you for joining us for our second part of our four-part series on tax planning. Today we are discussing tax forecasting and budgeting. If you look in the Q&A section, you'll see some links to our remaining two sessions if you'd like to register for those. I've also posted a link to sign up for our monthly email newsletter. If you're interested in that, it includes our latest accounting news and updates and announcements about any of our upcoming events and webinars. If you missed last week's webinar, we actually have it recorded and you can view that on our website. I'll post that link in the announcements as well if you'd like to go back later and watch that presentation as well. I'm going to go ahead and introduce our presenters. We have three presenters today. We have Greg Hyde, and we have Jim Bodwin, and Caitlin Hannafin. Greg Hyde is a tax partner with Squire. He has a Bachelor of Science and Master's of Accountancy degree from BYU. Greg serves a number of closely held businesses and their owners, executives and professionals, and high net worth and high income individuals. Greg is also the leader of Squire Wealth Advisor in the Salt Lake City office and enjoys the opportunity to help clients reach their overall financial goals. Jim Bodwin is a tax partner and a shareholder with Squire. He specializes in income and estate tax planning for individuals and businesses. He's a past president of the Salt Lake Estate Planning Council and the Financial Planning Association. He received his Master's of Accountancy and Taxation from BYU and is a licensed CPA, certified financial planner, and personal financial specialist. Caitlin Hannafin is a tax professional. She's been with Squire for 3 years. She enjoys tax because she gets to work with a wide range of individuals and businesses. So those are our presenters today, and I'm going to go ahead and turn it over to Greg to start off the presentation.
Well, thanks so much, Sarah. And it's exciting to be with all of you today to talk about tax forecasting and budgeting. And as we look at tax forecasting, you know, the forecast, that reminds me of the weather and looking into a crystal ball and trying to look ahead. There are so many factors, right? And it is an inexact science for sure, but we are here to help you, and with our knowledge of current tax law, as well as understanding and educated guesses about what the laws will be in the future. You know, as we look at tax forecasting, we have what I call micro and macro factors. You know, those first two, change in life circumstances or change in business structure or activities or employment, those are kind of at the micro or personal level, right? And then changes in tax laws and changes in the overall economy, those are more of the macro type factors. As you think about tax forecasting, a lot of changes that happen with your tax status, you know, of course, go along with changes in your life. And so we've listed just a few of them here. You may have a change in marital status. Well, what provisions does that affect? For example, as you switch over from single to married filing joint filing status, the standard deduction amount doubles. For 2020, the standard deduction amount for single individual is $12,400. For married filing joint, it's $24,800. For those over 65, those numbers are slightly larger. Another example, of course, as you change marital status is that you need to remember filing status is determined as of the last day of the tax year. And so as you go either from single to married or married to single, think about, you know, where you'll be at the end of the year. If you're going to joint, you of course have to consider the income and deductions of both spouses. You may analyze whether filing jointly or filing married filing separate makes sense. In most cases, filing jointly is the better answer, although there are some instances where separate is a better choice. Of course, with the change in marital status, you have changes in the tax brackets. As you get up into the very high income levels, you'll see there is a marriage penalty built into the income tax brackets. So at the top tax bracket, why single individuals, two single individuals rather, pay tax at a lower overall rate than marrieds do. Up to that point, the brackets mirror each other. There are a number of other tax provisions that are affected by filing status, and so just be aware that a change in marital status can have a significant effect on your tax situation. Changes in dependents, whether you have a newborn or maybe you have some older kids who are moving on, there are, again, a number of provisions in the tax law which come into play here. The child tax credit, the credit for other dependents, the earned income credit, education-related provisions. Those are some examples. We often get asked about what are the effects of a significant inheritance. For income tax purposes, fortunately, in most cases, inheritances are not taxable. And under current law, most inheritances receive a basis adjustment under Section 1014. We typically call that the basis step up, although in some cases it results in a basis step down. Now, of course, as with anything in the tax law, your specific situation needs to be evaluated. I've listed one of the exceptions to the rule of an inheritance not being taxable, and that's a retirement account. There are other types of assets which you might receive, called income in respect of a decedent. There can be issues with businesses and trusts and so forth, which also can be exceptions to this general rule. Some other changes which can come into play. I mentioned education costs. Here's a listing of some of the tax incentives that are out there related to education costs. In some cases, evaluating whether a dependent or the parent would most benefit from claiming education costs is worth your time. That's what we're referring to up there at the top, especially where scholarships have been received. The American Opportunity Credit is a 4-year college cost provision, which can be beneficial, as well as the Lifetime Learning Credit, the tuition and fees deduction, and the student loan interest deduction. Now, each of these have income-based phase-outs. The lowest phase-out of those 4 is the Lifetime Learning Credit. It's phased out at $136,000 of adjusted gross income. Talk to us about specific questions you have in these areas. Home ownership is another significant life change. In many cases, those who purchase a home will start itemizing their deductions, and that's because of the real estate property tax deduction. Although that has been limited for the last 3 years to a $10,000 maximum, and that $10,000 also includes state and local income and income or sales and property taxes. We'll discuss this a bit more later. There is a possibility that the $10,000 limit will be relaxed in the coming years. The mortgage interest deduction, that can provide a significant benefit. The home office deduction in some limited situations can help. And I wanted to mention that moving expense deduction, except for some in the military, active duty military, that was repealed starting with 2018. Let's talk about briefly changes in business structure or activities. Whether you're starting a new business or about to acquire one or sell one, you know, these events can have significant tax effects. And it's best to get your tax advisor involved early on in the process. So the choice of entity is one factor that comes into play, but then I mentioned there that the structure of the actual transaction is extremely important. I've listed here just a couple of examples for brief illustration. Let's say you're trying to start up a technology business. You want to be very thoughtful about how you'll structure it. In some cases, a C corporation structure may make sense in order to position yourself later for what's called QSBS treatment. In other cases, in order to retain some avoidance of double tax and capital flexibility, maybe a partnership or an LLC structure would make sense. That's just one example. Another example I mentioned here is, let's say you have an operating business that's going right along, but maybe you're ready for a change and wanting to sell it. Typically, it'll make the most sense for you to start looking at structuring years in advance of a business sale in order to optimize the tax outcome. All right, this is a real hot topic right now as we all lost sleep watching the not yet finalized outcome for the elections. As you know, income tax laws, they become very political. Just over the last several years, there have been several acts that have been passed. The Tax Cuts and Jobs Act was passed in December 2017. And that was in effect for 2018, 19, and now for 2020. Then the Secure Act was passed by Congress in December of 2019. That had many changes, mostly related to retirement plans. The CARES Act was passed in March 2020. That was in response, of course, to the COVID-19 pandemic. Now we have the Paycheck Protection Program, or PPP, which many of our clients were able to apply for PPP loans, and that was the intent, was to help a small business be able to survive through the early months of this pandemic. Well, now many are asking about forgiveness, and that's an ongoing concern. And then what in the world's going to happen in 2021? Well, I think most of us understand now that we're not going to know who will be in power until January 5th at the earliest, and that's because the state of Georgia won't have their special election for their 2 contested Senate seats. They won't have that until January 5th. And if the Republicans take one of those 2 seats, then it appears that the Republicans will hold the Senate. But if the Democrats take both of them, it appears the Democrats will hold power. And why does that matter? Well, it matters because President-elect Biden's proposals will not get fully enacted if there is gridlock, if the Republicans hold the Senate. And in fact, very few of them may be enacted. So we need to keep our eyes on what happens with those 2021 changes. Jim, I'll turn it over to you.
Thank you, Greg. And it's good to be with everyone this morning. Greg has talked about some of the theory that goes into estimating and projecting. Now we need to talk about actual calculations, because you really have to run the numbers to make the best decision. And the law has become so complex that kind of eyeballing it or back of the envelope estimates will mostly get you in trouble. So really you need a robust computer program to be able to accurately look at your tax situation for the current year and in the future. You can't really do income tax planning just for a single year. You have to at least look into the next year so that you can compare your levels of income and deduction and what the tax rates are and what they could be. And so that's one of the difficulties, right, of tax planning is these tax laws change so often. And Greg went through a number of those that occurred just in 3 years. And some of those laws, like the CARES Act, for example, retroactively changed the tax rules for what occurred in 2018 and 2019. So all you can do is the best you can with what we know and educated guesses about the future. So some of the basic questions are, should I take additional income in 2020 if I've got the control and power to do that, or should I push it off to 2021? What about deductions? Well, that really depends on your margin, what's called the marginal tax rate. If your rate is higher in 2020 versus 2021, then of course you want to push your income into 2021 where it will be taxed at a lower rate. But on the other hand, your deductions will be worth more. And so maybe you want to accelerate those. And it's by timing of payment for deductions, it's timing of receipt on income. And the situation could reverse, right? 2020 has been a tough year. Maybe 2021 will be better. Maybe the tax rates will be increased under the new administration. So lots of things to think about. Let's move on to the next slide, please. So here is a rate bracket for 2020 for single and joint filers. If you look at that, you can see some pretty big steps between the brackets. If you look at 12%, the next bracket up is 22, that's a 10-point jump. If you look at 24, the next one up is 32, that's an 8-point jump. And so part of the planning is taking a look at which bracket would apply. So these are your marginal rates. So for an example, if you had $100,000 of taxable income and you were a married person filing a joint return, you could see that you would be in the third bracket, the 22% bracket. That is called your marginal rate bracket. So if you earned $1 more, it would be taxed at 22%. But many tools out there will just use the average or the effective tax rate, which is really the wrong information. At $100,000, there's $13,600 total tax paid on that taxable income. So some programs might indicate you're in the 13.6% bracket, but that isn't so. So we have to be careful that we know the difference between marginal rates and average rates. Now, if you think about some of the Biden proposals, he's thinking of increasing the ordinary tax rate at a level above 400,000 to 39.6%. So if you look across in these rate brackets, you can see it's a lower number before the highest rate comes in. And so it could be a significant increase depending upon your brackets. One other item that he's proposed, and who knows if it becomes law, but it's a proposal to be aware of. Itemized deductions normally save you taxes based upon your rate bracket. He's proposing to limit it at 28%. And so you can take a look at that and see where that fits. And so that might influence the timing of your tax deductions. Do you want to prepay some in 2020 versus 2021? Next slide, please. Let's look at the second bullet here and talk about long-term capital gains and qualified dividends. Surprisingly, these types of income have their own rate brackets, and we just have them in words here. There's actually a 0% rate bracket for these kinds of income, up to 40,000 single or 80,000 joint. and then a 15% up to those limits, and then above that 20%. So this is tax favored income, long-term meaning more than 1 year capital gain or qualified dividends from corporate stock. One of the proposals under the Biden administration would be to increase the tax rate on these kinds of income, but not until $1 million is reached. So kind of a long ways off, but it could affect somebody that's selling a business. And so many people are considering whether to close on the sale of a business in 2020 versus 2021. Next slide, please. In addition to income tax changes, there have been large changes in the estate and gift tax area. When the Tax Cut and Jobs Act was passed, it doubled the lifetime exemption from gift and estate tax. You can see that there in the third bullet. It's a very large number. In 2020, 11.58 million per person, so it's just a very few at the very top that would be subject to these taxes. And those people are busy planning right now, because under the Biden administration is proposed to reduce that significantly, perhaps even as low as $3.5 million, which would affect many more people. Another of the proposals is to do away with the step-up in basis that Greg talked about. So when a person dies, the income tax basis of the asset changes to be the fair market value on the date of death. Because of inflation, most of the time it's a step up, but if there was a value decline, it could go down. Under the proposal, this would be done away with and no step up, and that would affect everyone, not just the affluent people. Next slide, please. 2020 has been a very tough year for most people. Many businesses have suffered. I was speaking with a client in the hospitality business just a couple days ago. When the coronavirus hit in the spring, occupancy dropped to only 10%. And then as things looked better in the summer, occupancy went to 50%. And now that things are getting worse again, it's down to 30%. So very tough to make money in that area, in that industry. But we did receive some good news yesterday, potential for a vaccine from Pfizer. And so maybe things will begin to change for the better next year. Next slide, please. So the CARES Act that was enacted in March of 2020 was designed to provide money for vaccines, for responses to the coronavirus. It also created the PPP loans, which were business loans that businesses could apply for to help retain their employees for a period of time. And the loan is forgivable based on how the money was spent. And the thing about the PPP loan program is the rules have changed so often. And the forms for forgiveness, for example, have changed a lot as well. Most of our clients have not yet started the process to apply for forgiveness of the loan. That loan can be forgiven if you meet certain thresholds, such as spending at least 60% of the loan proceeds on compensation and retaining a full-time equivalent headcount. When the amount is forgiven, it's not taxable. But the IRS rained on that parade last summer when it issued a notice saying that the expenses paid with forgiven loan money are not going to be deductible. So a real problem that's arising right now that we don't have the answer to is, what if you get your loan forgiven in 2021, which most people will do, but the money was spent on expenses in 2020. So do we have to go back and amend 2020 and disallow those deductions? Will Congress change the law to overrule what the IRS held? This might be an instance where if you usually file on time, you could go ahead and get your tax return done, but you might want to extend just to see if anything changes so you can avoid an amended return. There might also be a CARES Act 2 that comes out in the spring. Who knows what kind of tax provisions might be in there and whether they would have retroactive effect. So lots of things are in commotion, and we here at Squire are keeping our eye on what's going on and be pleased to help you think through some of your planning and the actions that you should take. So now let's talk about how we pay for taxes, and we'll turn the time over to Caitlin to talk about tax budgeting.
Thanks. So now we're going to talk about tax budgeting. So the federal and many state tax systems require taxes to be paid as you earn or receive taxable income. And this just helps you from spending that money that is due to the government as taxes. So if you are a W-2 employee, you'll see that withheld on every pay stub. It's automatically done by your employer. But if you're self-employed, it's up to you to determine the amount you owe throughout the year so that at the end of the year you aren't penalized for underpayment, which we'll talk about later on. Some income you can decide if you want them to withhold taxes throughout the year or if you just want to pay them at the end of the year because it's not going to be that much. That would be like Social Security, IRAs, with COVID, unemployment will be a big one. And then some income is not subject to withholding. An example of that would be interest income, so through your bank. The next slide. So if you are a W-2 employee, taxes are withheld automatically, but you get to decide the amount of withholdings, and that is done when you fill out a W-4. So once you start a job, you'll fill out a W-4, and this form helps determine the number of allowances you have, but you don't have to claim that amount. You could choose to claim less or more depending on your situation. And at any time, you could go to your employer, fill out a new W-4, and have that amount changed. So some individuals do choose to have more withheld, so they claim less allowances than they have. Usually this is due to them having income from other sources, so they don't want to have underpayment penalty. You do want to make sure, though, that you aren't having your employer hold way too much, because even though you're going to get that money back as a refund when you file your tax return, that is money that you could have all year either earning interest in a bank, in the stock market, or using for other things that you need during the year instead of just letting the government use that money for a whole year interest-free. Next slide, please. So if you're not a W-2 employee, you're self-employed or have other income, which withholding is not done automatically, you should consider making estimated payments. And there's a few ways you can determine the amount of estimated payments you need to make. You could first use your current year liability, but if you know you're going to have a spike in income or a drop in income, you would use your current year liability but adjust for that known change. Also, a great way is to get with an accountant, do tax planning, and then they can determine the amount of taxes you should pay with those estimated payments. And then estimated payments are paid 4 times throughout the year: April 15th, June 15th, September 15th, and January 15th. Next slide. Okay, so penalties and interest. So if you don't pay enough, there is an underpayment penalty. There's a late payment penalty. So that's if you get to the end of the year, have too much taxes owed that you don't have that amount, so you have to wait and pay that later. There's a late filing penalty, and then also IRS payment plans. So again, if you have a big amount due with your tax return, you don't have that money, so you create a payment plan through the IRS, they are going to charge you interest on that payment plan. Next slide. So the penalty for filing late is 5% of the unpaid taxes for each month they are unpaid, and this starts the day after the deadline. This penalty will not exceed 25% of the unpaid taxes. To avoid this penalty, just get your tax return filed before or on the due date. Penalty for underpayment. This one is always changing. It's based on a federal rate, updated quarterly. Right now it's 3%. To avoid an underpayment penalty, taxes must be paid through timely estimated payments or withholdings. And back when we talked about figuring out how much to pay in estimated payments, this is why you could use your current year tax because your current year tax, because if you pay 100% of the tax shown on that prior year return, you avoid a penalty. But if you owe 100 and your income is 150,000 or more, then you need to pay 110% of that prior year tax. And then if you're a W-2 employee, or, just make sure you're paying 90% of your current tax due to avoid that penalty. The penalty for late payment of tax is 0.5% per month up to a maximum of 50 months. Next slide. So with COVID, the IRS understands that it's been hard, so they have put in some new initiatives and tried to help out taxpayers. So this first link you can go to, it just shows those IRS taxpayer relief initiatives you can read about, see if those will help you out. The second link is for payment plans. There's some general questions and answers. So like, do I qualify? How much do they cost? What do I need to apply? And then if you want to apply, that same link you can follow to apply or revise any current payment plans. So now we're going to go back to Greg.
Thank you so much, Caitlin and Jim. And just finally, we wanted to mention, as you're budgeting for tax, of course, the federal government isn't the only entity to which we pay tax, but the various states, whether Utah or other states. And so here we've listed a few of the different tax considerations for businesses. There are often minimum taxes, licensing requirements, and whatnot. And we, of course, are happy to help you evaluate these issues and plan for the various state obligations as well. Here you can see our email addresses. If you wish to contact us further, we'll be happy to talk through any questions you have. Thank you.
Great, thanks Greg, Caitlin, and Jim. Appreciate your time and your effort in this. If anybody has any questions they'd like to submit in the live Q&A, we can take them now. And if we don't see any come through soon, we'll just go ahead and assume that you're going to reach out to the presenters separately. And it's looking like we probably don't have any additional questions. So thank you all again for coming, and hopefully we will see you next week for part 3.